Greetings. My name is Marcos Mendoza, and today we'll be discussing sensitivity analysis as a tool of capital budgeting. Our agenda for today's presentation will discuss the following areas: introduction to sensitivity analysis, qualitative analysis, ethos pathos, quantitative analysis, logos, finally, project risk and capital budgeting. Sensitivity analysis is a tool used in financial modeling to analyze how the different variables of a set of independent variables affect a specific dependent variable under certain conditions as defined by the Corporate Finance Institute. Sensitivity analysis is also known as the what-if analysis. This analysis will isolate each of these fixed and variable costs and record potential outcomes. This provides analysts and business leaders information to make informed choices and manage risk in their organization. For example, what would happen if a quick service restaurant that was affected by rapidly increasing poultry prices, causing the business to have to reconstruct their kitchen to onboard new protein items? Sensitivity analysis may be useful to the operator to determine if the kitchen expansion is worth the risk or if they should adjust their current price structure to negate the expansion project. This analysis will determine the project's success or failure. Qualitative analysis, ethos pathos, is an evaluation of the company's quantifiable aspects such as management style and worker loyalty as defined by Investopedia. These analyses can be collected using case studies, focus groups, narratives, online feedback, reputation-based platforms, and polling. Qualitative analysis focuses less on numerical attributes and more on management or leadership of the business, internal systems, and processes. Brand values or societal behaviors are areas of analysis that provide valuable insight to this method of analysis. When looking at qualitative analysis, it's reminiscent of two of the three pillars of human persuasion: ethos and pathos. The emotional, ethical, and character of the organization is always a valuable form of evaluation. However, they alone cannot predict the success or outcome independently. Quantitative analysis, logos, is defined by Investopedia as a set of techniques using mathematical and statistical modeling, measurement, and research to understand behavior. This method of analysis presents information in a numerical format using financial statistics and statistical modeling. Additionally, it uses numerical charts, algorithms, and graphs over a period of time and tracks patterns of market behavior. This method is also has recently been infused by artificial intelligence, or AI, as the information and the data analysis are repetitive in nature. Due to its use of numerical evaluations, mechanical learning, or ML, has also been integrated into this method to increase productivity and labor hours with data analysis. Quantitative analysis is the third and final pillar of human persuasion, or logos. This form of analysis is numerical and dry, or logical. However, its specificity provides raw numerical feedback that is needed when analyzing the fiduciary outcome of a project and its potential net present value, or NPV. When used independently, it falls short of the total project risk in the intangible part of the organization. Qualitative and quantitative analysis, ethos, pathos, logos. Ethos, an appeal to credibility, character, ethical, or morals. Pathos, an appeal to the emotion or feeling. Logos, an appeal to logic or reason. When combined, the steps of qualitative and quantitative analysis, the ethos, pathos, logos, we find that each method by itself has vulnerabilities and limitations. However, when blending these methods, an Aristotelian triad of financial analysis, having a project with the right people, the right message, and the right numbers is what drives investors to commit capital to the business vision of the organization. The messaging of the analysis needs to not only be met financially, but provide human inspiration. When evaluating these combined methods of analysis, they provide a well-rounded perspective of human persuasion and financial success. Project or long-term capital investments come with various degrees of risk. Controlling or reducing your organization's liability to that risk should always be at the forefront of capital budgeting. These projects can promote growth in a sector or provide a much-needed expansion to scale. However, when improperly analyzed and implemented, it can lead to financial ruin. Understanding sources of risk can provide certainty and uncertainty depending on the company's cash flows and estimation of capital resources. Sources of risk include project-specific risk, company-specific risk, industry-specific risk, market risk, competition risk, international risk. All risk must be considered to project the probability or certainty of long-term capital investments. Capital budgeting, project risks are a combination of the metric NPV. This considers the time of money value and incorporates the discounted rate that reflects the inherent risk of the project. If the NPV is positive, the project is more likely to generate more than the initial investment. If the NPV is negative, it shows the high risk discounted rate and will ultimately result in a lower NPV. In conclusion, we discussed introduction to sensitivity analysis, qualitative analysis, ethos pathos, quantitative analysis, logos, and finally we discussed project risk and capital budgeting. This concludes my presentation of sensitivity analysis, a tool for capital budgeting. Thank you for your time and attention.